Hi there everybody, and welcome back to another stock analysis video. Today we are going to be analyzing the company Lilly. Now, fun fact about this company is that this was actually recommended by, once again, Elizabeth Shelbourne, where she pretty much said, can you please do a stock analysis on LLY, which is Lilly? Thank you. And I was just like, you know what? The fact that they do also have earnings today as well, I was just like, you know, sure, why not? I wasn't planning on doing it, but the fact that they do have earnings, I may as well just go for it, right? So we're going to be analyzing this company, guys. It is a pharmaceutical company, to see if maybe at the current share price, we would like to buy it. So with that said, let's get started with this analysis. Jumping into the dividend summary, guys, Eli Lilly actually does pay out a pretty good dividend in my personal opinion. Current dividend yield of 1.22%, which is low. However, this actually comes out to be, guys, 98 cents per share for an annual payout of $3.92. The payout ratio is 39.57%, which is actually fairly good. However, in regards to the free cash flow, we don't necessarily know yet. And since cash flow is what companies use to pay out this dividend, then we're going to take a look at this just to make sure that it still falls within at least my personal margin of 60%. The 5-year CAGR on this dividend is looking pretty good too at 12.18%, meaning that within the past 5 years, they've grown this dividend at this rate, and they have consistently grown this dividend for 8 consecutive years. Not too shabby. Ex-dividend day is actually coming up on the 12th of this month, 12th of August. Payout date is actually going to be on September 9th, and they pay their dividends quarterly. Jumping into the calculator, we got the ticker symbol of LLY, market cap of, look at this, $303.3 billion. PE, guys, of 46.57%. That is absolutely massive, right? Absolutely massive. And with a current share price of $313.83, I don't know, this is pretty much just telling me that they are very much overpriced in accordance to their earnings. However, earnings is just one metric. We're going to take a look at other ones, free cash flow, revenue, and shares outstanding, to see if maybe we could come up with an intrinsic value for the company. Now, looking further into this dividend, which I forgot to put here, I am so sorry, of $3.92 annually. Guys, this comes out to be almost $3.5 billion being paid out in dividends every single year in accordance to the numbers of shares that they have outstanding today. And if we take a look at the average 5-year free cash flow after this dividend is paid out, guys, they're still left with $1.2 billion. That's actually not too bad, honestly. And if we actually take a look at last year's free cash flow and do the same math, they still left with $2.4 billion. Not too shabby either. Taking a look at these payout ratios, though, we can see that when it comes to last year's free cash flow, they're at 59.3% as a payout ratio, which is a little bit high, but still under 60. However, on their 5-year average free cash flow, they are above 60% at 74.39%, which unfortunately is above what I personally like to buy a company at solely for their dividend, because it's getting closer and closer to 100, and at 100 they start taking on debt, meaning that they can't afford the dividend anymore. So yeah, that's essentially why I like 60 or under. I think 60 is a pretty good buffer. And now let's take a look at some of these fundamentals, starting of course with the net income of 5 years ago, guys, of negative $204.1 million to 1 year ago of $5.6 billion. Increase of, look at this, 2,835%. Absolutely massive. However, guys, taking a look at this graph, this is not looking pretty in the slightest, right? It's not consistently increasing, and while they are positive as of last year and even as of 4 years ago, the fact that they just went from negative 204 to then 3.2 billion to then 8.3 billion to then 6.2 billion, so they actually dropped from 3 years ago to 2 years ago, which was, again, this was during COVID, a surprise drop for a pharma company. And then from 2 years ago to 1 year ago, they did another drop of around $1 billion or so. Yeah, that's not consistent at all, guys. And unfortunately, based off of this, I'm gonna have to give it a pretty low score at around like a 35%, just because it is positive, but it's just not consistent enough for me to actually feel comfortable when it comes to this profit metric. And now looking at the free cash flow, cash from operations less your capital expenditures, the most important of all profit metrics, because this is the one that pretty much the company uses to operate as a whole. They use this to pay down their debts, buy back shares, issue a dividend, grow the company, and make acquisitions. So very, very important for this thing to be in the positive for starters, as well as consistently increasing. And Well, unfortunately, 5 years ago, guys, they were at $5.4 billion to 1 year ago of almost $6 billion, increase of 31% with a 5-year average of $4.7 billion. Now you're saying that's a pretty good increase. However, guys, looking at this graph further, you can see that from 5 years ago to 3 years ago, they were decreasing, and then from 3 years ago to 1 year ago, they essentially just doubled, right? So that's not consistent enough for me to actually feel comfortable about this. However, I guess it's a little better than the net income because at least there is no negatives in this case. And, you know, the fact that 5 years ago it was on par with what 2 years ago was, I guess that's slightly better. But even then, guys, I have to give this a pretty low score still, just because of the fact that they're just not consistent. However, they are in the positive. So I'm actually going to give this at around like a 60% or so, just because of the fact that at least we don't see any negative numbers when it comes to this. And now looking at the revenue, we got 5 years ago of almost $20 billion to 1 year ago, guys, of $28.3 billion. Increase of 41.78%, and this is exactly what I like to see when it comes to a company's profits, right? Nice consistent increase, staircasing as I like to call it, staircasing year over year, and this is looking very, very good, guys. I'm essentially going to give this a 100% because this is exactly what I like to see. Now analyzing some balance sheet numbers, starting with the difference of assets and liabilities. Basically, can the company's assets cover their liabilities? This is important because if they cannot do this and we go into a tailspin in the economy, chances are the company will go bankrupt. Now, as it stands, guys, they're currently at $9.5 billion in this difference. However, while this is positive, and I'll give them this too, within the past 5 years, they have been positive. Take a look at this. From 5 to 4 years ago, it was a drop from $11.6 billion to $10.9 billion. And then from 4 years ago, which was at $10.9 billion to 3 years ago, they went down to $2.7 billion. Massive, massive drop, guys. I don't necessarily know what caused this. And if we actually take a look over here at their fundamentals, we could see that around this time it was actually a case that their total assets decreased, going down to $39.286 billion, and their liabilities shot up to $36.5 billion. So that's essentially what caused this issue right here as of 3 years ago. Unfortunately, that is going to make me put a lower grade for this. However, they have recovered ever since, not to the level of 5 years ago, but they have recovered still. Average total assets around $45.1 billion, average liabilities around $36.8 billion, and doing this difference, we get $8.3 billion. Overall, guys, I'm going to have to give this at around like a 45%. Just because of the fact that it's just not consistent. It's positive, sure, but it's just not consistent at all. And now we can take a look at the cash flow minus the liabilities. Cash flow, it is what companies use to pay down their liabilities, right? Company doesn't use their assets, they use their cash flow. So what we do here is we take the cash flow year over year, which we just saw up here, as well as the liabilities year over year, and subtract them, right? And essentially what I like to look for when it comes to this metric, guys, it is not so much that they're in the negatives, because most companies are in the negatives, but at least are they getting closer and closer to zero, right? And unfortunately, this is not the case when it comes to Eli Lilly. Currently, guys, as of 1 year ago, they're at negative $33.7 billion, down from 5 years ago of $28.7 billion. And as you can see also, they actually reached the peak 2 years ago, which is not surprising during COVID, of $35.7 billion, and sure, they did buy back a little bit here and there to negative 33.7, but it is still on the decline. If we take a look at the average cash flow minus the average liabilities, we get around negative $32 billion. So unfortunately, guys, I'm actually gonna have to fail this one again. I'm gonna actually give it at around like a 40%, just because of the fact that it is decreasing, but you can see they are slightly getting ahead of this as of 1 year ago. So we'll see where this leads in the future, but I have to give it a 40%. And now looking at the shares outstanding, the metric that tells us whether or not the company is diluting you as the investor by issuing more shares. If they are buying more shares back, meaning that this number is decreasing, they're giving you a bigger ownership of the company. And for companies that also pay out a dividend, it is beneficial for them to buy back shares, because this is a dividend that they no longer have to pay out. So it's very, very important for this thing to be buying back shares. And when it comes to Eli Lilly, we got 5 years ago of 1.05 billion shares to today, guys, of 900.2 million shares. That is a decrease in the 5-year of 14.27%, which is actually fairly aggressive. And from the previous year to the current year, they bought back almost 0.4%. This is looking at 1 year ago to today. Not too shabby, guys. Overall, this is looking fairly good. They did a massive decrease from 4 years ago to 3 years ago, and even from 5 years ago to 4 years ago. Look at that, 1.05 billion to essentially 1.007 billion. That's actually really good, right? So I'm actually going to give this, guys, a fairly high grade. I'm not going to give it a perfect just because it's not consistently, right? They're not buying back shares at a consistent rate, but they're still buying back shares nonetheless. That's why I'm actually going to give this actually a 95%, just because it is really good, and it's also really aggressive. And now lastly, looking at the cash and equivalents, we got today of $2.45 billion with an average cash of $4.35 billion. So let's actually do a quick recap. Net income, guys, 35%, free cash flow 60%, revenue 100%, assets minus liabilities 65%, cash flow minus liabilities 40%, and shares outstanding of 95%. Overall, guys, the total grade is actually a 65. So it's almost there to, I guess you could, what I would consider passing, right? Passing, I would consider like a 70%. It's almost there. Honestly, the main issue here, guys, is that income as well as the assets minus liabilities, because, you know, the net income, guys, we did see a negative number and it's not consistent at all. So that's essentially what's dragging this company down. So unfortunately, a grade of 65%, it is still failing, but if they get their fundamentals a little bit better, they actually might be into my 70% range when it comes to passing this company. Alright, now let's come over here and make some assumptions, low, medium, high, using 3 different factors: revenue growth, the predicted share buyback, and of course the required rate of return. Guys, for the revenue growth, let's come over here to Seeking Alpha's growth tab, and we can see that the revenue growth forward is 7.5%, and the revenue growth year over year has been 15%. So my job as an investor, guys, is to be conservative when it comes to these assumptions, right? I don't necessarily know what's going to happen with the economy. It is getting pretty bad out there, but we'll see where we go, right? I don't think pharma companies are going to go out of style anytime soon. So for the revenue growth, guys, I have to be fairly conservative, and I'm going to say at around 5% for the low assumption. Median assumption, let's say at around 7%, and for the highest assumption, let's say at around 9% or so. Now for the predicted share buyback, guys, we did see that they are buying back shares at 14% or so. Will they continue to do this in the future? Probably not. So I think that for the low assumption, the worst that they'll do might be at around the same, around 5%. Let's do the same thing for the median assumption at 7% predicted share buyback, and then a 9% for the highest assumption. And of course, we keep the required rate of return the same at 10%. So this actually gives us some target share prices. For the low assumption, it is now $492.28. Wow, that is actually amazing. Median assumption, it is $538.09, and the high assumption, it is $587.65. Wow, that is actually incredible to see. Now we need to adjust for debt. The way we do this is we take a look at the cash and equivalents, take a look at the net debt, and if they have more debt than cash, then obviously the number comes down, and if they have more cash and debt, the number comes up. So you can see it does come down to $479.76 for the low assumption, $525.32 for the median assumption, and $574.61 for the highest assumption. Now, adding a margin of safety of 5, 10, and 15% on top of this, this puts me between the buy ranges of $407.80 to $455.77 for the low assumption. For the median assumption, it is $446.52 to $499. And for the highest assumption, guys, it is $488.42 to $545.88. Now, the current share price is $313.83. In every single scenario that you see here, guys, this is essentially a buy. And I can already hear the comment section. Eli Lilly has never been above 400. How could you say that it'll reach a high of 587? Okay, the way this kind of free cash flow works is we are projecting the cash flow using revenue and net income into the future, discounting it back to today, and then dividing that value by the future current shares outstanding. At least that's the way that I like to do it. Basically, if I'm saying that the company will grow at 5% within the next 4 years, as well as they'll buy back shares at 5%, this indubitably says that the fact that they're buying back shares and that their revenue is growing, it pretty much just means that the value of the shares that you have right now are growing massively, right? And I fully understand that the 52-week high when it comes to Eli Lilly is $335. I fully understand that this has never gotten there, but this is not a prediction as to what the company will go to. This is a prediction as to what the company should be worth. And again, because every investment is the present value of all future cash flow, and none of this is financial advice, guys, if you change these numbers for whatever reason, let's just say that you believe that they'll actually do negative revenue, let's say negative 5% within the next couple years, as well as that they'll actually issue shares at like negative 10%, actually let's just say negative 5% as well, well, we can see that now the target share prices are very, very differently, right? Now we get 311, which is on par with the current share price, and then the target share prices after that, it is, you know, under 300. So it really just depends as to what you believe this company will do in the future, right? I don't think that they'll do negative. They don't have a precedent for negative revenue, right? I mean, I gave the revenue a 100% score just because it is essentially perfect. It is increasing as well as consistently increasing. So I don't see precedent for this. So that's essentially what I'm getting. Now, as I just showed with changing these revenues and predicted share prices, guys, you guys should get this calculator. It's available for free, as well as my book ratio calculator, the reevaluation calculator, and even a dividend tracking sheet, which, by the way, this company does pay out a dividend. We'll go further into this in just 1 second. All I'm asking for in return, guys, for these free things as well as free content pretty much every single day, and sometimes more than one video a day, is just like, subscribe, comment. It really does help with the algorithm on YouTube, guys. Thank you so much for everybody who have subscribed. Almost to 800 subscribers. That is absolutely insane. Thank you so much. And you know, it really does motivate me to get comments like from Elizabeth saying, hey, you know, can you analyze pharma companies, because I want to buy pharma companies. I don't know which ones to get. You know, that motivates me and it makes me really excited to start building this community when it comes to investing through a fundamental process. It's really, really exciting. So thank you so much for everybody who have subscribed. Really do appreciate it, and I'm looking forward to continue growing this community. Alright, now let's take a look at this dividend, because, well, at $3.92 annually, let's say that you make the average monthly income of $5,725. How much will this company pay you annually, right? If you were to put in 1 month's income? Well, at the current share price, guys, this would buy you 18.24 shares, which isn't a lot at all. And this would actually come out to be an annual dividends, guys, of $71.51, quarterly dividends of $17.88, and a monthly dividend of $5.96. So unfortunately, it's not a company that's that good for its dividend. There are better ones out there, but if you guys believe my assumptions, then you know, you might consider buying this right now, because if it's worth $500 at the max, right, then you might consider buying this right now, because if you're getting 18.24 shares at 313, if this thing continues to pop, then you will get less shares in the future. However, let me just all remind y'all again that when it comes to the cash flow, we are fairly close to that 60%, and even beyond that for the 5-year average. So something to definitely think about when buying into this company solely for a dividend is that they may not be able to actually pay it off in the very near future. All in all, guys, Eli Lilly is a company that essentially, well, you know, I have a lot of pharma companies, and this was just one that doesn't really intrigue me. I have companies like AbbVie, Johnson & Johnson, Amgen, right? And I've actually bought most of those companies at a really good value. And from what it's looking like, Eli Lilly might be a fairly good value today as well. But when it comes to these metrics, guys, when it comes to these fundamentals, they are not as good as you would think, right? Also, I forgot to mention that when it comes to pharma companies, you guys should really take a look at their drug pipeline proposals, because companies that are in pharma, they are subjected to the patent laws and essentially as to how long they have those drugs in patent for. If it is close to the patent expiring and the drug going generic, then they might lose a massive chunk of this revenue when that time comes. Just like we're seeing with AbbVie, they're pretty soon going to lose Humira, and that's a huge revenue drop. So take a look at the drug pipeline when it comes to this company, guys, and make sure that all of their drugs are still in patent before you actually buy into this company thinking that you are safe. That pretty much is it for this video. Like to feel like, comment, subscribe. As I said, you guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.